What has driven the rise in dealership sale-leasebacks? Let's just define what this even means. Can you give us the SparkNotes definition? What is a sale-leaseback?
Sale-leaseback is an alternative financing solution, and it functions as a debt and equity substitute for businesses to make products and provide services. So mechanically, you're selling owned or controlled real estate, and you're maintaining operational control of that real estate by leasing it back from an investor for a long period of time. Most typically, it's a 15 or 20-year lease where you're with several tenant options to extend. So you've got control over this real estate for a period of 40, 50 plus years in total. But given that real estate ownership is not core to most businesses, particularly dealerships, right? Owning the real estate is not core to selling cars. It's a great tool that extends a significant sum of capital. We'll get 100% to 150% plus LTV financing on real estate.
Why are dealers looking to sell their real estate as a form of financing nowadays? Is it simply the fact that cap rates, valuations went up, and so there's more liquidity potential? Or is there other things I'm missing? What has changed that has really enticed dealers to at least explore this form of financing if they want to grow or whatever?
Sure. I mean, one piece of it is, and I've heard so many people come onto your show and talk about the importance of scale and diversification within their dealership platform, and being out there and active in acquiring other dealerships as they come up for sale is of great importance to a lot of dealers out there. So a lot of this M&A activity is important for fueling sale-leaseback transactions because nature of the access to capital. If we're talking 100% plus LTV financing on the real estate, you're financing a massive portion of the acquisition, and you can stay liquid and maintain the ability to recycle capital and continue growing via acquisitions or development.
Are there any specific areas that you're seeing more appreciation? Are we expecting that a Toyota store is like super safe and secure, and so you're just going to pay more for that? Give us a little bit more behind the scenes of kind of your thought process.
I'll break this out into geography, and I'll break this out into brand, right? So if you're looking at Toyota relative to Stellantis right now, dealers are going to be much more excited about an acquisition opportunity that flies a Toyota flag than a Stellantis flag. Personally, I'm seeing a lot more dealer acquisitions that are of Stellantis points rather than Toyota. And the Toyota ones are going to transact a lot quicker and at a greater blue sky multiple. If that multiple for the enterprise acquisition is greater, it is less additive relatively for that dealer to execute a sale-leaseback. But if you're paying 8 times blue sky for a Toyota dealership and we're simultaneously executing on a sale-leaseback for the real estate at 13 to 15, 16 times, that delta is less significant. Whereas if this is a Stellantis dealership and you're able to acquire the enterprise at maybe it's 3 to 4 times earnings, and we're executing on that same sale-leaseback at 12 to 15 times rent multiples, then it is financing that multiple arbitrage that exists is so much greater.
So you're saying that the dealers are benefiting more from the less sought after brands because they're just simply getting a bigger spread on what they're paying versus what you would be paying. Is that correct?
Yeah. And like Yossi, we should take a step back for a quick second and just say at SAB, it's not our own balance sheet that we're buying this real estate off of, and we're not acquiring it ourselves. We're acting in a brokerage capacity and acting as a fiduciary and an advisor to auto dealers that are executing on these transactions. So it wouldn't be us directly that are making these acquisitions, but I think if we look at it from the lens of that multiple arbitrage again, I think it is significantly that delta that exists between 4 times blue sky and 13, 14 times rent is greater than 8 times versus the same rent multiple. And even if we take that down to a more compressed cap rate or a more significant rent multiple, that delta is still less significant for a Toyota brand. But it all depends on what is most important to the dealer involved in the transaction. And that's the way we start off every conversation. What is most important to you? Is it limiting cost of capital in this transaction? Is it limiting rent load over the span of the lease? Is it getting the greatest proceeds figure? What that's going to do is going to impact cost of capital more than anything else.
Do you find it tough to value these properties, right? The dealership real estate is so core to the operation. And clearly you're in the business of selling cars. The real estate is just bricks. How big is that spread across different regions when it comes to the actual valuation of the real estate?
Yeah, so part of that process is qualitative and part of that process is quantitative. Quantitatively, we want to understand what market rent looks like in that geography. Is this rent affordable for the dealer? We want to understand what the average cap rate of commercial properties transacted in that geography are. And then the other piece of it, when you talk about just evaluation as a whole, is how profitable is the dealership? So that's a big piece of the quantitative part of the analysis. But the other piece is like qualitatively, what brand is this dealership? Again, like we talked about the difference right now in perception and performance between, Toyota and Stellantis. That you're going to see wash out in cost of capital, represented as cap rate. So you're likely to see a more compressed cap rate. In an apples to apples comparison, all else remains equal, you're likely to see a more compressed cap rate for a Toyota dealership relative to a Stellantis dealership.
So I'm going to put my dealer hat on and say, if I met you, I think the first question I've tried to figure out right away is, does this hurt my brand value? So if I sell my bricks today, and then 5 years later, I decide I want to sell the business, the enterprise, I'd have to imagine that you've studied that or looked back at prior results or anything. Can you shed a little light on that side of the world and how selling the real estate impacts the dealership's value long term?
If you look at dealership buy-sell transactions, right, you're buying goodwill and you're buying the real estate. Most typically, that's the most common, right? And real estate is obviously a significant portion of the total valuation or compensation in that transaction. So if you are selling the real estate in a sale-leaseback transaction today, you have the immediate access to that capital to be able to reinvest it into that business. Maybe it's growing in buying another point nearby, or maybe it's reinvesting that capital back into the business and seeing an improvement in performance in the short term. So that when you go and you're selling the enterprise later on, assuming there's improved performance there, the blue sky multiple on a greater figure is going to yield a greater proceeds figure. And just know that you've already cashed out on the real estate, but you've benefited from reinvesting that into the business.
So you're basically saying that during a sale of the business, these two pieces are anyways segregated, the real estate and the business, which is true. And so it's sort of just it's mutually exclusive opportunities. And this is just one way to take advantage of the real estate without selling your actual operating business.
One important piece of that, in that transaction where you tied the sale of the business to the sale of the real estate to the same acquiring business owner, you're most typically going to value the real estate at appraised value. And that appraised value is going to be tied to the utility value of that real estate for that dealer and some function of local market comps for vacant and utility value real estate, right? But if you execute a sale leaseback, when I say you're getting 100% plus LTV for that real estate, that might be as high as 150% LTV. That's of appraised value. So you're getting a greater proceeds payout from the real estate via sale leaseback because now you're valuing it based off of the income stream from rent.